So if you have a credit card, you've probably seen that interest rate creeping up. But what you might not realize is just how high it's gotten. And more importantly, who is profiting from your debt. Today, we're going to pull back the curtain on what some are calling the 22% trap.
Yeah, it's a question millions of us are asking ourselves. You know that feeling? Every month, that balance just seems a little tougher to chip away at as the interest charges grow. Well, we're going to break down exactly why this is happening. And spoiler alert, it's not just about inflation.
Okay, here's the number that should really make you pause. As of May 2025, the average interest rate on a credit card that's carrying a balance is a mind-blowing 22.25%. Let that sink in for a second. According to the Federal Reserve, that is a near record high.
And look, this didn't just happen overnight. It's not some sudden spike. If you rewind just a decade ago, the average rate was a much more manageable 12.9%. But by 2023, the extra profit banks were making from these higher rates cost borrowers an additional $25 billion. And now, here we are staring down 22.5%. This is a deliberate long-term trend.
So, how in the world do we even get to a number that high? In this first part, we're going to peel back the layers on that 22.25% and find out where it really comes from.
The big secret here is a concept called the APR margin. Now, I know it sounds pretty technical, but it's actually simple. It's just the gap between what it costs the bank to borrow money and the rate they turn around and charge you. Put simply, this is their pure profit margin on your debt. And this chart, wow, it just shows you how wide that gap has become. Banks will often point to their funding costs, the prime rate, which is around 8%, to justify rate hikes. But just look at their profit margin on top of that. It's now 14.3 percentage points. That's nearly double what it was a decade ago. This isn't just about covering their costs, it's about generating enormous profits.
And hey, don't just take my word for it. This isn't just our analysis. This comes directly from the Consumer Financial Protection Bureau, the nation's top financial watchdog. They're the ones who've identified that this APR margin, the part beyond what banks need to cover their own costs, has nearly doubled.
So if banks are making these historic profits, who is actually paying for it? Well, the answer might surprise you. It reveals what's basically a massive wealth transfer. You could almost call it a middle-class subsidy.
And this is not a niche problem. We're talking about over half of all American households, 56% to be exact, are currently carrying credit card debt. This isn't about a few people struggling. This is the financial reality for the majority of the country.
And the average amount they owe is over $6,000. When you're paying 22% interest on that kind of balance, it stops being just an inconvenience. It becomes a direct transfer of wealth, moving from your family's budget straight into the bank's profits year after year.
Those high interest payments from millions of households are, in effect, a subsidy. We normally think of subsidies as something the government hands out, right? But in this system, it's the middle class that's directly subsidizing the record-breaking profits of the nation's largest financial institutions.
So why is this all happening now, and what even allows it? Well, it turns out the entire system has been structured over time to favor these exact outcomes. Let's take a look at the mechanics.
It really boils down to 4 key reasons. First up is market concentration. Just 10 companies control almost the entire market, which really limits competition. Second, you've got regulatory loopholes that let national banks bypass strict state laws. Third, there are weakened protections. When a recent rule to cap link fees was defeated, banks just responded by hiking interest rates even higher. And finally, hidden fees. Merchants pay about $172 billion in swipe fees every year, a cost that gets passed on to all of us as higher prices.
And the results of all this are just staggering. Take a look at this comparison. The average profit margin for a general retail business is about 3%. In 2024, JP Morgan Chase's credit card division saw a 32% margin. Citigroup's was 16%. These aren't just competitive profits. One study called them super competitive, which is a fancy way of saying they're so high it suggests there's a real lack of market competition.
And this has consequences for everyone, even if you don't have debt. When households are spending more and more money just servicing debt, they're spending less on actual goods and services. The White House Council of Economic Advisors estimates this could actually slow down the whole economy, potentially shaving 0.3% off GDP growth.
Okay, so the situation seems pretty grim, but you are not powerless here. It is absolutely possible to break free from this debt trap. This last section is all about the clear, actionable steps you can take to fight back.
The key is to be proactive. First, prioritize paying off your highest rate cards. Then, look for those 0% balance transfer offers, but always read the fine print on the fees. And here's a fantastic tip. Just call your card issuer and ask for a lower rate. Seriously. The data shows that 76% of people who ask for a rate reduction actually get one. You can also switch to smaller banks or credit unions. Budget carefully. And remember, there are nonprofits out there that can offer free help if you need it.
You know, it's important to see that there are really two paths to change here. There's the personal action we just talked about, which is so important for your own financial health. And then there's systemic reform, pushing for policies like the Credit Card Competition Act, which is designed to lower those swipe fees for everybody. And to really fix the problem, you probably need both.
And that leaves us with a final question to think about. Is the burden entirely on individuals to just budget their way out of a 22% interest trap? Or do we also need to demand a system that doesn't prioritize these super competitive profits over the financial health of its citizens? The answer is likely a little bit of both.